All right. So good evening, everyone. Looks like it's right at 6 o'clock, maybe a little bit after. Let's go ahead and get this webinar started. First, I just want to thank everyone who showed up, especially everyone who showed up on time. I know time is the most valuable non-renewable resource that you have, and I do want to make sure that we're respectful of that. I would expect this webinar to take anywhere from maybe 30 to 40 minutes for the main presentation, plus however long it takes to get through the question and answer portion. Speaking of questions, if you do have any questions at any time, please feel free to click on the Q&A button at the bottom of the screen and type them in at any point. If there's one that's particularly applicable to what we're going over, to what we're talking about, we'll try to cover that during the presentation. But anything we don't cover during the presentation, we'll make sure to cover that at the end during the dedicated Q&A session. And I realize some questions might just be too complex or just too personal to answer in a public webinar setting. So if you do have one of those more complex or more personal questions, let us know and we can schedule a specific time to talk about that. You can let us know in the chat, give us a call, or just shoot us an email and we'll get it figured out. We'll get you a time. With that out of the way, let me go ahead and introduce Phil Lynch. Phil is the Regional Director for Russell's U.S. Private Client Services. He primarily works with financial advisors like us. He helps us improve our business and helps communicate with clients. And he's been working with Russell since all the way back in 2006 and has been in the industry for years before that. We decided it'd be valuable to bring him in to come talk with you all directly. Phil recognizes that when it comes to investment returns, it's not just what you make, but it's what you get to keep that actually matters. And just our relationship with Russell. So as independent financial advisors, we're able to use a whole wide variety of different investment providers and mutual fund companies. Russell is one of the small handful of companies that we find ourselves coming back to again and again, and not just for our clients, but for ourselves as well. Cheryl, David, George, Linus, and all of our spouses all use Russell Investments in our own taxable investment accounts as well. We put our money where our mouth is, quite literally. So with that, I'm going to go ahead and turn this over to Phil and Josh to help teach us how to actually maximize after-tax wealth.
Great. Good evening, everyone. Thank you, Logan and Linus. And I appreciate being here tonight, and hopefully everyone survived the inclement weather in the Carolinas today. So it was white knuckle driving on the roads, but good to be with you all tonight. I am the regional director, as Logan highlighted, work out of Charlotte and cover all of North and South Carolina, and been in the industry a long time. Also joined with my internal partner, Josh McCarthy, out of our Wisconsin office. So all the rain we got today is turned to snow where he is in our Milwaukee office. So it's nice to be able to have virtual settings from home or a hotel, wherever we all are. But this is a really important topic. This has been one of our most important topics that we've shared over the last number of years with both our advisors and in turn clients, meaning all of you, is how do we focus on after tax, right? So we're going to have a discussion on tax-aware investing and how do we improve the outcomes of after-tax wealth, right? We know that we have to pay Uncle Sam, and there's a lot of activity that we can take to help minimize that tax bill. And frankly, the industry doesn't always do a good job of making investors aware of things that we can control. And I always say, we can't control inflation, we can't control tax policy, but we have some semblance of control of the taxable experience in client portfolios. As Logan highlighted, Russell is an industry leader in this space. We've been running tax-managed bond portfolios since the 80s. We've been running tax-managed equity portfolios since the 90s. And we have been running global allocated portfolios, of which we'll highlight today, for over 22 years, one of the longest in the industry. And we're at the forefront in terms of thought leadership and things we can be doing. Certainly, and we'll hit a little bit more on the end, but taxes are most likely not going down. They're most likely going up from here. So what are the things that we can be doing between investors, advisors, and the money managers, us, to help put our clients in the best outcomes possible? So that's what we're going to focus on, and feel free to ask questions along the way. So Josh, we'll get started. You can kind of control the deck here. The first thing, we love our friend Albert Einstein. The hardest thing to understand in the world is income tax, right? There's over 3 million words in the income tax right now with all the riders. So it is complicated. here is the landscape. Right now, there's about 28 trillion with a T of taxable investment, or excuse me, open-ended mutual funds out there between active and passive, and roughly 47%, or almost half, are taxable dollars in taxable investments. And so there's a lot of opportunity. And why this happens is if we inherited a mutual fund or an investment from a parent or grandparent, and it has a low cost basis and we haven't sold it, we just hold on to it. But many times what we find is they're in very tax inefficient vehicles, and we don't sell it because we want to realize capital gain, but then it's just this wall of worry, and it just eats up and it grows and it gets more difficult. So we really think this has been the opportunity to sort of revisit, if we've got taxable accounts, to make sure they're in the most tax efficient areas possible. And this is really the growth opportunity of our industry over the next several years. You look at the agenda here, we're going to look at the problem, we're going to look at the tax impact on investment returns, we're going to talk about some solutions and really the opportunity. What are some practical things that we can be looking at as you're working with Logan and Linus, and really the landscape going forward? So we'll take a look at the problem. When we think about tax in general, what are some of the common tax costs, right? We've got capital gain distributions, which we'll get into more detail as we go along. But distributions with mutual funds typically happen in November and December. They hit our 1099 statements in April. So we've got the annual cap gain distributions, of which they have to distribute mutual funds 98% of capital gains in a calendar year. And we've got dividends and interest, and certainly that interest number has creeped up with interest rates having gone up the last few years, especially with cash and cash-like investments. But there's also those hidden tax costs underneath, right? Money managers make asset allocation changes, and when they buy and sell to rebalance, that can trigger capital gains. Money manager changes. A lot of the industry, when they hire and fire managers and reposition, that can also trigger a tax. And then there's rebalancing. There's a lot of managers out there that are called tactical, and they do a lot of buying and selling throughout the year, and they try to do it maybe with low cost index funds and things. But if they make 6 or 8 trades in November, December, that can trigger a tax. So we got to really look at all of the potential areas where we can get dinged on a tax. And there's ones that are right in front of us, right in the mirror, but there are other ones that we want to make sure we're absorbing. So let's look the last couple of years. You go back to 2022, wasn't such a friendly environment for the market returns. For those of us, it was, markets were down about 20%. Roughly 70% of equity funds paid a cap gain distribution to shareholders in 2022, and the average was 7%. So it didn't sit well if you had a small cap fund that was down, 22%, and you had a 10% cap gain that year. Those are tough conversations, and we as investors can forget, because again, those distributions are made, and then come spring, we're looking at our 1099s and we're saying, oh my goodness, why am I paying tax on something that lost money? The good news is with Russell, we've been zero. We were zero on a down year. We don't want to kick you as clients when you're down. But if you took this same information here and rewind to 2021, it was a different picture. 2021, the markets were up 23% or 28%, and 83% of cap gains, and the average was 12. So the problem persists whether markets go up or down, and that's what you have in front of you here. We're going back to 2001. The blue chart shows broad market returns of the Russell 3000, and this red line going through the middle is the average cap gain. I always like to start with 2008. 2008, we all remember, during the global financial crisis, markets went down 37%. But we still had an 8% capital gain distribution in 2008. And why is that? It's because the industry had eroded all those loss carry forwards from 2003 to 2006, or really up to 2007, when the markets were cooperating and doing pretty well. And then we hit a little bit of a tax holiday in 2009 through 2013. But essentially, we've averaged right between 6 and 12% over the last decade of what we call cap gain distributions. Even in 2018, you had 11%, pretty substantial number. That's a percent of the NAV of the fund that distributed a capital gain. And so in 2018, you can see the markets were down 6%, and there was still 11% capital gain. Doesn't sit well. The numbers still coming out for 2023 came down a little bit. The average is right around 5%. So the markets were up last year. If the S&P was up 23, the average about 5. But this is a really good picture here to reiterate that markets go up, markets go down, markets stay flat, but this cap gain distribution is looming, and we want to try to solve for it. So when we take a look at when we pick investments in general, it can be a mutual fund, a separately managed account, an ETF, it can be really anything. Oftentimes the first thing we look at is the expense ratio. And as fiduciaries, that's something we should look at. If we've got two mutual funds do the same thing and one's a little bit less expensive, we got to consider that. But we as an industry oftentimes focus on what we call the wrong fee. The expense ratio is one part of that, but the tax drag, or what that investment's annual tax drag, is oftentimes 2 times what the cost or the expense ratio is. And so what you can see here is in US large cap, you're down on average almost 2% a year is lost to taxes. So if the fund returns 10%, you're going to lose 2% or 20% of the return to taxes. And so that's just something that we need to keep our eye on, is oftentimes going with the lowest cost implementation doesn't always reap the best tax situation. We want to be cognizant. That's why you work with advisors who can help navigate through that. Because let's look at the power of taxes, right? You take a $500,000 portfolio in 2022, and if the average cap gain was 7%, that's $35,000 on a 1099. And if we're in the 20%, we assume the 20% long-term capital gains rate, that's a $7,000 tax due. But if you look on the right, Uncle Sam and Aunt Betsy, or as we say, there's UNC colors and Clemson colors, depending on where you stand here. If you had been more tax efficient, that number came out to 0. And so what we're doing is we're taking a percentage story and putting it down, distilling it down to dollars and cents, right? It's one thing to say, hey, we can save you 2% a year, 2.5% a year in minimizing taxes, or we can save you $7,000, $10,000, $15,000 a year on your tax bill. That sort of starts to hit home. So it's really, really important to make sure that we take a look at kind of the impact. And you can see here, just looking at that tax bill, on what you're saving over a 10-year period starts to add up with a role of compounding. And so if we've got more to reinvest back in the portfolio, we're going to come out ahead over longer periods of time. And I actually like the next slide really talks about the role of compounding. So you take that $500,000 portfolio and you've owned it for 20 years, and you look to the right, and the industry average in equities is 2% tax drag over the 20-year period, growing at 7.5% a year. It's worth about 1.4 million. Not terrible, but we are giving up some dry powder there. If you cut it in half, it's worth about 1.7 million. Or if you really get it close to 0, we are at Russell been between 0 and 25 basis points. You're well over 2 million. So this ending wealth effect, just out on $500,000 portfolio over long periods of time, is over $500,000. That's real money, right? That's real savings that can go a long way in terms of financial planning and retirement. So we would just like to highlight, if you keep more, as Logan said at the beginning, it's what you keep, not what you make, and reinvest more. So how do we do it? It can get complicated. So we just sort of want to highlight some of the action steps that we take at Russell to sort of view this problem. These are all things that the advisors do, your advisors do, and the money managers do, but it can be very time consuming. And we've got 75 people in Seattle, where we're headquartered, that do this for over 50 billion of assets. So one of the things that we look at as an active money manager is tax loss harvesting. A lot of advisors, if they're picking their own stocks and things like that, tend to harvest at the end of the year, November and December. And, going back to the 1950s, November and December have typically been good months for the market. November, December, and April have been the top 3 calendar months of the years going back to 1952. So that's your trivia for the night. And the mutual fund industry distributes the cap gains at the end of the year. So in essence, if we wait till the end of the year to do it, whether we're doing it ourselves or running our own portfolios, you could be selling into what's known as a positive market and not maybe getting the best outcomes that we're looking for. We at Russell believe in tax loss harvesting throughout the year opportunistically when things are down, and really trying to reposition the portfolios regularly to come into the end of the year to minimize. And that's what we've been able to do the last number of years. We've been pretty close to 0 the last 3 or 4 or 5 years to try to minimize that by harvesting on the dips and creating what we call tax asset to offset future gains, so we can come in and have very, very little cap gain distribution. The other is wash sale minimization. That can get a little wonky term, but if we want to sell Pepsi and buy Coke, we at Russell, because we sub-advise our mutual funds, can swap the lot from Pepsi to Coke, so you're still in the same sector, and then swap it back after 31 days to avoid what we call a wash sale violation, which can trigger penalties and things like that. So we want to make sure we got flexibility to absorb losses, and then we can reposition the portfolios to still stay in the same sector. You can look at Lowe's and Home Depot is another example of that type of. So we're always looking at making sure we're adjusting the lots and refreshing it to minimize our taxable distribution. The other is tax lot selection. You know, if we've owned Netflix and one of our money managers had it for 8 months, the other's had it for 8 years, we want to look at the long-term versus the short-term capital gains and make sure that, you know, it can be very prohibitive if we're having a lot of short-term capital gains, when we can minimize that and make it long-term. When long-term can be as high as 20, short-term can be as high as 43, 44%. You have about an 82% difference. So there's a lot we want to look at. We at Russell, and we'll show you a picture in a few minutes, but we have the money managers underneath the hood that make up our funds, but we control all the trading. And so all of our money managers give us a trade report each week, and we're going to look at the lots to make sure we're finding the best price lots that are going to be the least tax penal with any trading that's going on. The other I'd like to highlight here is fund yield management. We actually pay a lot of our fees out of yield, because the yield and interest gets taxed at ordinary income. So if we're high earners and we've got, you know, at the high 30 tax bracket, along with the net investment income tax, we can be well over 40%. That can be very penal as well. So we want to make sure we're looking at all these things. But the key takeaway here is, when you work with a firm like Russell, and that's why Logan Linus really rely on us to look at these portfolios and look at the landscape to make sure we're doing everything in our power to find not only the best risk-adjusted return, but the best after-tax return, and try to minimize that to lower your tax bill going forward. When we look at the S&P and you look at the dotted lines, it's really looking at calendar year 2022. And you can see on the left there, the S&P 500 index return in 2022 was down about 18%. But here's the opportunity you see in the red. Now, the market was down, but 2/3 roughly of the S&P individual securities were down. So this is what we're trying to take advantage of, is throughout the year, each month, trying to book losses in these portfolios to offset future gains. And this is what money managers are doing. It's just, if we're just buying indexes and things like that, can we take advantage of the opportunity of the individual securities at the index level? And that's really what we're striving to do with our money managers, just to focus on the best after-tax results and do it throughout the year when we've got dips in the portfolios. When we think about counter years, and this is going back to the last 30 or so years, 1996, in 21 of the last 27 years, U.S. equity markets finished in positive territory. However, the average annual pullback is about 15%. Again, so this is why we're not a buy and hold. We want to make sure we're active and trying to take advantage of those dips in the portfolio. And this is just another way to highlight that. So we talk a little bit about, it's not what you make, it's what you get to keep. You've shared a lot of that lingo. I'm going to pass it off to Josh here to talk about, okay, you've talked a little bit about the market opportunity. You've talked a little bit about how you do it. But as it relates to the partnership with Linus and Logan and the portfolios, what are you actually doing? What do we own? And how are we doing it? So Josh, you want to jump in and spend a couple minutes on the construct of the portfolio, and then we'll show them the sample?
Yeah, absolutely. Really do appreciate it. And kind of what you're seeing here is the 5 different portfolios, the model portfolios that we have. On the bottom right, you will see the makeup of those portfolios. So we have 6 different tax managed funds, U.S. large, U.S. small and mid, international, real estate, and also we have tax exempt bond in our tax exempt high yield bond fund. So we mix our U.S. small and mid cap, for example, just for tax loss harvesting purposes, makes it easier rather than being completely split up. Also, same with international. International is made up of about 80% developed, 20% emerging markets. Again, we use that together. We mix those together sometimes in core portfolios when you don't have to pay taxes on retirement accounts. We have those funds split up. But for the tax side, or for the tax managed side, it makes it a little bit easier for us to do type of things like tax loss harvesting. But at the end of the day, you have all the way down from ultra conservative, you can see, which has very little equity, and then all the way up to aggressive growth, which has which has only or a lot of equity. So no matter where you're at, we're going to have a solution for you, and you'll kind of see the makeup a little bit of the moderate portfolio on the next slide. So that's kind of your basic 60-40, general 60-40 portfolio. So as you can see under the hood, and Phil has alluded to this as well, we are sub-advised. So we are looking at all these money managers and we're picking them and we're giving them specific mandates. So in our tax managed US large cap, for example, as you can see on the left side, we have 4 different money managers. And at the bottom, that rim, that's Russell Investment Management. And that's where we're doing the tax overlay. But we're giving, Brandywine, JP Morgan specific mandates based on how we want them to make trades and invest. So if whoever is going to be the best at value stocks on the US large cap, then great. If we want growth, right, we give everybody different mandates based on their abilities. And that comes from Russell's money manager research that's been around for over 80 years. So this is kind of the breakdown of a moderate portfolio. Again, kind of like your traditional 60-40 portfolio with a little bit of cash, as you can see. All right, so kind of put your money where your mouth is. This is from 2022. This will look very similar for 2023 because all of those numbers, again, are going to be zero. Our tax-exempt bond fund, for example, it's been around since 1985. It has never distributed a capital gain. So we're very proud of that, but this is just kind of showing the numbers. And going a little bit farther back to 2015, so the past 8 years, these are our capital gain distributions for each of those individual funds. As you can see, we have had a few years where there are capital gains, but they've all been under 1% and very minimal. So we're proud that the last 2 years, we have kept it at completely zero. And it's been that way for quite some time. And then again, we saw this chart earlier, but we're going to make one little tweak to it, and we're going to add in the orange line, and that's going to be the Russell Tax Managed US Large Cap Fund. And it's just kind of highlighting, like Phil said, the market goes up, the market goes down. The only one that tends to always win is Uncle Sam. And so we're trying to reduce those taxes as much as possible and grow your after-tax wealth. And then I will send it back over to Phil.
Thank you. Yeah. And one of the things just to highlight when he showed you the sample portfolio was, there might be some recognizable names there. You see, a Brandywine or JP Morgan, there's some names that you might be familiar with, but just note that even if those firms run their own version of a mutual fund, this is an exclusive portfolio that they're running just for Russell clients. And so even though they might be known in a certain asset class, we're getting kind of their best ideas and we're combining it with 3 or 4 other managers to create what we'd call a mini portfolio across all those asset classes. And if you've got 2 or 3 or 4 managers, some are in favor, some are not, you're sort of building a mini portfolio. And the idea there is if we can smooth out the ride or the return within that asset class, we improve that probability of providing better outcomes for you longer term on an after-tax basis. And you saw this chart earlier, looking at that tax drag and really emphasizing this, is the dark blue is really highlighting that actively managed tax drag. The lighter blue is sort of highlighting the passive tax drag. Now, passive investments, index funds, ETFs generally are less expensive and generally are more, we'd call more tax friendly, but they still throw off dividend income, and there's a rebalancing of the indices every year based on cap weightings, and it can trigger, and it's still over 1 on average in the databases. And you can see in the orange, we've done a pretty good job getting it close to 0. And I think that's, again, trying to keep what you make is really what the name of the game is here. And this is just another illustration. We've talked a lot with our advisor partners, especially after last year, with interest rates having gone up, that municipal bonds, and going into this year too, we do actually like the bond market, both taxable and tax managed, because if the Fed does begin to cut this year, which we think they will by spring, whether they go 3 times, 4 times, generally that bodes well for intermediate longer term fixed income. So, but we're just trying to highlight, we run 2 municipal bond funds, as Josh highlighted, a tax-exempt muni and a high yield municipal bond. But we really are looking at tax equivalent yields relative to corporates. One of the things that comes up a lot is investors, we all liked that CDs were, and cash was paying 5% last year, but it does impact the tax bill relative to when you're getting 1. But we sort of peaked in rates there. And so we probably won't see much higher than that. And so what this is really highlighting is that what do I need to not be in a municipal bond? You need over a 7% yield to be tax equivalent to versus the municipal bonds at 4.3, and pretty attractive municipal bonds. Same thing on the right. The blue is just showing more higher yield or lower quality credit. You need over 10% yield not to be in a high yield municipal bond. So municipal bonds, we do like. Default rates generally are lower than corporates. And we think going into one, of both uncertain tax picture, but two, with what we think with Fed cutting rates, it's a good time to be evaluating that as we move into the year. So we kind of look at the opportunity. Another quote we love from Will Rogers: when you find yourself in a hole, the first thing you do is stop digging. And this really gets to the impact of, if I've owned something and I haven't gotten rid of it, what is the problem? And so we just look at a couple framework conversations. One of them is, if we've owned a mutual fund and it's kicking off 7, 8, 9, 10% of what we call capital gain distribution, does it make sense to start taking the free cash flow of that distribution and redeploying it to a more tax-friendly investment rather than reinvesting back in the same mutual fund or investment vehicle that is very unfriendly on the taxable side? There's some things that we can do, and starting to dollar cost average out is one thing that we see a lot of our advisors and clients doing. Is if we've got cap gains, maybe we start pulling money out over the next couple of years, and sort of spread out the pain over a couple of 1099 seasons just to reposition the portfolio. And the other is, when we've got some break-even analysis tools, and feel free to reach out to Linus and Logan, we can run some analytics. But, if you've got unrealized capital gains in something, it's 35 to 50%. And hey, if we can reposition it and it's going to be about 2% more tax efficient over the next number of years, what is my break even for why I shouldn't do it? And if the break even's 3.5 years to get back to where you were and then be more tax efficient going forward, and I don't need it's long-term money, probably makes sense to do it. But if it's money you're going to need to tap into the next year or two, then you'd want to reconsider that. And that's part of the planning process. But we've got a lot of tools and resources internally that we can share with your advisors, with Linus and Logan, and help sort of ascertain whether it makes sense to transition. But I always like to end with kind of, we as clients, you as clients on the line, and prospects and things of that nature, who benefits from being in tax managed? And we sort of going left to right. Once taxable earnings is north of really $90,000 a year, we jump from that 12 to 22% federal bracket. Example I always like to use: I work with some advisors in the Raleigh market who work with many professors up at RTP, and they're constantly reminding the professors who, do pretty well. This is not just the high earners. You don't have to be making $1 million a year to see the impact of, being in more tax investments. $90,000 is a good living, but that's where the impact starts to happen. And a quarter of our income for every dollar earned thereafter goes to Uncle Sam. That can leave a lot to be desired. And so taking considerations around where we can be more tax efficient with our non-qualified assets. The other is receiving large lump sum distributions. If we're selling a business, sell real estate, that's been a big one in the Carolinas, with so many people moving to the Carolinas from higher tax states. And, I know me living in Charlotte, I've got a lot of neighbors who moved in from Chicago and upstate New York and higher tax areas. And, there's real impact, and that's usually non-qualified assets, selling of real estate, inheritances, insurance. Trust is another big one. We do a lot of trust work, and since we're fiduciaries and sub-advise our funds with outside money managers, spreading that risk around. But all it takes is about $14,000, $15,000 of income to hit those progressive tax rates in a trust. So making sure that within a trust, are we in more tax efficient investments to minimize that tax drag? A lot of cash on the sideline. Pre-pandemic, there was over 6 trillion, and we're right around 5 trillion still, and people were getting paid on that cash. But we're seeing a lot of our investors start to move that cash and CDs coming due back into the markets, and we're looking at very conservative model portfolios where you're still 70-80%. Josh showed you, our conservative models are essentially 70-80% fixed income on the municipal bond and 20 equity. You get a little inflation hedge, where you're being paid away with yield and potential price appreciation. So not a bad time to be considering getting into more conservative, moderate global portfolios from cash, because we think we sort of peaked in rates. And then, of course, I look to the far right, non-qualified. If we've got high cap gain distributions with the size of our accounts, we can look at our 1099s. for clues to make sure we're in more tax efficient vehicles. But, there's a lot of opportunity. And, when we think about, and we get wonky talking about taxes, I know Logan Linus do too, but the reality is the Tax Cuts and Jobs Act from 2017 was done through reconciliation. That expires in 2025, right after this next election. Why that's important is we have this year and next year as it relates to planning with the uncertainty of taxes. And if we have divided government, we don't know, they can't even agree if the lights are on up there. But if we do have divided government in Washington going forward, high probability, generally it's good for the capital markets because they can't get out of their own way. But that also could mean if the tax reconciliation lapses, we're going to roll back to Obama rates, which could be a tax increase. So we need to be prepared for that. And we need to be talking about it and thinking about that. And what are things we can be doing now to make sure we can create better outcomes for our legacy going forward. So I always say, even if, taxes most likely are going up because we've got a revenue and a spending problem, we all know that. And that's talking the policies, not the politics. But unfortunately, with the $8 trillion that has been on the books the last 3 or 4 years from COVID, much of it, justified, it does put us in a very difficult situation. We're reducing the debt. So we'll see where they go on this, but very, very tough conversations to be had up there. So just all things to consider there. We're not going to spend a lot of time here, but if you have statements and things you want Logan Linus to look at, we can also run illustrations and backward-looking illustrations, forward-looking. We can do tax impact analysis. There's a lot of thought leadership we can bring to analyzing situations that might be helpful in your conversations. And additional tools and resources, feel free to reach out to Logan Linus. They know where to find us for anything that we want to highlight here with our website. And we've got tax handbooks and things like that. But, we really want to thank you for allowing us to spend 20 or 30 minutes, kind of walk through our process a little bit, why this is so important, why it can get very complicated, and why you're in good hands with Logan Linus. They do a great job, and we're very fortunate to have a good relationship with them. And hopefully, as we go forward with the uncertain landscape, we can find ways to be helpful to you all on the line. So with that, Logan, we'll kind of pass it back to you to wrap up. And any thoughts on your mind, or we can certainly open up to Q&A.
Yeah, I appreciate it. I think now's a great time. If you have any particular questions for myself, Linus, Phil, Josh, any of us, now's a great time to put that in the Q&A if you have any questions. But while that's happening, Phil, I think one point that I'm sure you and I understand fairly well, but not everyone may have a perfect grasp on capital gains distributions. So, like, for example, if I have a mutual fund that I bought, let's say at the start of 2022, I don't sell any of it, I don't buy any more, I don't do any trades at all. At the end of the year, I still have to pay capital gains tax on that, even though the fund went down in value in 19% in 2022. How does that happen? Why do I have to pay tax and I lost money?
Yeah, exactly. It just doesn't make sense. And if you take in 2022 is a good example where if you have a mutual fund, what the mutual fund industry has to distribute any capital gains over capital losses in a calendar year, and so they do it as a percentage of NAV. So if it's $100 and there's an 8% cap gain distribution, that distribution is distributed to all the shareholders that own shares in that mutual fund. And what they do is they just reduce the NAV. So if you went for $100, 8% is going down to 92, and you're reinvesting that back in the portfolio. So you've got more shares at a lower number. So you're still at the same number, but on your tax statement, you've got this 8% capital gain distribution. So the 100 went down to 92 because of the 8%. You still own $100 worth of that net asset value of the fund, but now you own some tax on that 8%. And if you're in the 30% tax bracket or 35 or 20, there's going to be a percentage of that 8% that you're going to owe tax on. And it's either going to be long-term or short-term. And if you're in mutual funds where managers are being thoughtful about that, if they have to do a distribution, you hope that they're looking at a lot that's long-term, because long-term capital gains can be as high as 20% or 23.8 if you really want to break it down. But if it's short-term, well, then we get taxed at our ordinary income rate, and that can be in the high 30s, close to 40% for higher earners. So, it's just something that, and Josh can maybe we have a little illustration, Josh, that walks through the breakdown that's on the CPA deck. We can send you a copy of that actually walks through that example of the mutual fund where it's dipping in NAV, you reinvest, you're still earning the same amount, but now you got to pay tax on that distribution. So even though we own the fund, we have no control what those cap gains are going to be because that's at the fund level. It gets evenly distributed to all the shareholders. And that's where it's tough because that happens in November, December. And then come April, we get the call and we're calling Logan Linus. We're saying, well, why did I have to pay a cap gain on something that lost me money? And that's what we're trying to minimize. So good question.
That was my first investment experience when I graduated high school. My aunt and uncle gave me $500 to invest. And so in July of 1978, I invested $500 in a mutual fund. At the end of the year, I had like $480 in it, and it had a capital gains distribution. And it took me a long time to wrap my head around. They had stocks that they sold during the year that they had bought years ago that made money, that generated that capital gain that I didn't get to experience, but I had to pay tax on it. And that was an unpleasant experience for my 18-year-old self.
My version of that story was when I got my first paycheck living in New York City, working for an investment firm up there. And I had my gross first paycheck, which wasn't very high, but it was a paycheck. But then when I got the gross to the net with the city tax and state tax and New York City tax, my take home, it was a real eye-opening experience. So taxes are real, whether it's investments and where we live and all of the above. And we want to make sure that we're being prepared and thoughtful around it. So yeah, it's real.
One more while I give people time to put in some more questions. So municipal bonds, why does it look like they have a higher after-tax yield even though their real yields are lower? How does that work?
Yeah, no, it's, and Josh can go back to that slide if you want, but basically, generally speaking, municipal bonds are not taxed at the federal level. So we take an average of what your tax would be, and municipal bonds generally are tax-free versus the corporate bonds. And so when we look at a break even, we look at what is, if we gross up, if they were to pay tax, what type of yield would I need in a taxable fixed income if I'm a taxable investor? And so if I'm getting 4% municipal bonds and I don't have federal tax, I'd need to be equal to over a 7% corporate bond to not be the municipal bond. So as non-qualified or more tax-sensitive investors, municipal bonds, one, they're both flush from cash from COVID because the federal government was distributing, but essential services, bridges, tolls, general obligation bonds, general revenue bonds, default rates are a lot lower. So they're a little less sensitive to interest rates, number one, but number two, the default rates are less independent of the corporate structure of that entity. And so because they're tax-free at the federal level, generally a lower yield municipal bond is still better than a higher taxable bond.
Yeah, that makes sense.
Good question.
So I see there are a few questions in the chat, and it's from one particular individual, and I'll go ahead and I think over the phone, voice-to-voice conversation is probably best. I'll go ahead and send you an email, and we can find a time to have that conversation. But other than that, it looks like we're all done for the evening. I want to thank everyone for showing up again. I appreciate your time. Josh, Phil, a pleasure as always. I appreciate your time and your expertise, and we'll talk soon.
Sounds great. I hope everyone has a safe week and a good week for everyone. Thank you.
Yep. Thanks, everyone.
Have a good night. Bye-bye.
Good night. Bye.